Good afternoon, traders. This is Jeff coming at you from thestockbandit.com with another video trading lesson. So today's lesson is a swing trading lesson. We'll be taking a look at HIG, Hartford Financial Services Group, and in particular, this one's going to deal with trading gaps. You know, a lot of times we see the market close one day and open at a different level the following day, creating a void on the chart. Which is known as a gap, and today we saw this occur in HIG, which is a stock that was listed in the StockBandit.com member area last night for a buy out of this bullish wedge. This is a bull pennant pattern that the stock has created after bottoming out a couple of weeks ago. We have a natural stop loss right here beneath the wedge area pattern, and the trigger price is going to be above the upper wedge trend line, which was at 76 and a quarter. Now, this morning the stock didn't open at that level, so let's take a look there. And here on the 1 minute chart, we see this gap that I was just referring to. You know, this green bar down here yesterday is where HIG finished, and this opening bar up here today is where HIG began trading, which was above $77. So, you know, anytime that occurs and you've got a swing trade where you know your entry, you know your stop loss level, and you know where your profit target is, it's time to adjust those parameters or adjust your trading size. Now, for me personally, with a swing trade, I like to set up my parameters ahead of time so that I can you know, create my conditional order and set it and forget it and just leave the trade alone and let it go. And that way I know at the outset of the trade that I'm putting money at risk where I've got a defined stop loss and I know what my upside is going to be, and then it's simply a matter of executing the trade and letting the trade play out the way it's going to. So today, for example, this HIG gap, you know, we see a gap of more than 1%, and when I see a gap of more than 1%, what I will do is reduce my position size by half. And what that does is still allow me to catch a good trade as the stock, you know, clears this trigger price and begins to move higher. It allows me to participate in more upside if the stock moves. However, because of this gap, the stock is now further away from my initial stop loss level. So, you know, in this case, it's further away by another 1%. So that means my risk on the trade has expanded. My potential max loss has grown in this trade, and so whenever that's the case, what I want to do is offset that by reducing my position size. So we'll take a look back at the daily chart, and we see that HIG is showing us a nice breakout out of this pattern as expected. It's still the middle of the trading day right now, so volume hasn't kicked up the way I will expect it to. But again, this trade is off and running. It's acting well and looking like a good solid bullish breakout, and I'm able to participate in further upside if it comes, but I've reduced my risk to offset the morning gap just in case the stock were to turn around. So that's today's lesson. Anytime you get a gap that's in the direction of the trade you're planning to take, just reduce your position size and you're still able to participate in the move, albeit at a smaller amount. So trade well out there. I'll see you at the next video.